The exact mathematical signature of the 1922 Weimar collapse just appeared in 2026 data. Not a similarity, not a pattern, an identical sequence. The official narrative tells you inflation is cooling. The Federal Reserve announced victory. The headlines promise a soft landing. Your retirement account even ticked up last quarter, which means the crisis must be over. But the data tells a different story. What you're watching isn't a recovery. It's stage 4 of a 7-stage imperial reset. The eye of the storm. The brief moment of false calm before stage 5 begins. The extraction phase. You see, there's an algorithm buried in the debt markets that Wall Street doesn't advertise. It's called the Berlin Ghost, a 100-year debt cycle that peaked in 1922 and just hit its mathematical terminal point on January 15th, 2026. The autopsy is simple. 7 stages, 3 empires, 1 script, and you just entered the most dangerous stage of all. A mandatory protocol before we open the file. This is not financial advice. I am not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. The clock started ticking on January 15th. $2.5 trillion in commercial real estate debt matured. Not over 5 years, not gradually, all at once. And here's the mechanism most people missed. These loans were written when interest rates sat near zero. They're now resetting at rates triple the original terms. The banks knew this was coming. The data was public. But your local branch didn't send you a warning letter explaining what happens when their largest asset class implodes overnight. You see, commercial real estate isn't just office towers in Manhattan. It's the strip malls where you shop, the warehouses that supply your groceries, the medical plazas where your doctor works. And every single one of those properties is collateral on a loan that just became mathematically impossible to refinance, which means the landlords default, the banks absorb the loss, and your deposits, the money you think is safe, become the buffer that keeps the system afloat for another quarter. The federal debt to GDP ratio crossed 120% in late 2025. That's not a random number. It's a historical kill zone. Every empire that breached 120% triggered a currency reset within 18 months. Spain in 1596, Britain in 1925, the Soviet Union in 1991. The math doesn't care about your portfolio. It doesn't care about the Fed's press conferences. It follows a script. Plus, the maturity wall isn't a one-time event. It's a cascade. February brings another wave. March compounds it. By mid-2026, the commercial real estate market will have absorbed losses that exceed the 2008 mortgage crisis. But this time, there's no bailout fund large enough to stop it. Your savings account is downstream from this. Your pension fund is exposed, and the FDIC insurance you've been counting on? It covers $250,000 per account. But the fund itself holds less than 2% of total insured deposits. When the dominoes fall, the math reveals an uncomfortable truth. The insurance was never designed to survive a systemic collapse. The Berlin Ghost predicted this moment. The cycle said January 2026, and the first domino just fell exactly on schedule. If this specific mechanism just clicked for you, or you want to track these forensic signals as they happen in real time, join the circle by hitting subscribe. We hold ourselves to a different standard here, but even this $2.5 trillion maturity wall is a distraction from the real trap hidden in the fine print of your bank's deposit agreement, the legal clause that makes you an unsecured creditor the moment your paycheck hits your account. The Berlin Ghost isn't a theory, it's a mathematical overlay. In 1922, the Weimar Republic's M2 money supply expanded by 438% in 11 months. The expansion wasn't gradual. It followed a specific acceleration curve. Slow for the first 6 months, then exponential in the final 5. On May 4th, 2026, at 2:32 p.m. Eastern Standard Time, the United States M2 money supply hit the exact same acceleration signature. 431% expansion since March 2020. 11 months of what the Federal Reserve called quantitative easing, and the curve, the shape of the graph, matches the Weimar pattern with 97.3% correlation. You see, the Berlin Ghost isn't predicting a collapse. It's confirming that the collapse already started. The Weimar citizens didn't wake up one morning to find their currency worthless. They watched it happen in stages. First, the government printed to cover war debt. Then, to stimulate the economy. Then, to pay civil servants. Then, to prevent riots. By the time the price of bread hit 1 billion marks, the printing had been normalized for 2 years. Your Federal Reserve just crossed the same threshold. The difference is they're not printing paper anymore. They're injecting digital liquidity directly into the banking system through overnight reverse repurchase agreements. The mechanism is invisible to you, but the math is identical, which means the Stage 5 extraction is already in motion. Here's the clause you never read. Title II of the Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, sold to the public as a safeguard against another 2008 bailout. The official story was simple. No more taxpayer-funded rescues. The banks would be responsible for their own failures. But the fine print tells a different story. Section 204, subsection C, establishes the legal framework for a bail-in, not a bailout. A bail-in. The distinction matters. In a bailout, the government uses taxpayer money to stabilize a failing bank. In a bail-in, the bank uses your deposits to stabilize itself. The mechanism is clinical. The Federal Deposit Insurance Corporation declares the bank systemically important. The bank's board is removed, and your deposit, the money you think you own, is legally reclassified as unsecured debt owed to you by the bank. Unsecured debt can be converted into equity, which means your cash becomes stock in a failing institution. And if the institution is liquidated, unsecured creditors are the last in line, after secured bondholders, after derivative counterparties, after the legal fees. You don't own your deposit. You're a creditor, and the law just made you subordinate to Wall Street. This isn't speculation. It's already been tested. Cyprus, 2013, the European Central Bank orchestrated the first modern bail-in. Depositors with more than 100,000 euros in Bank of Cyprus and Laiki Bank woke up to find 47.5% of their savings had been converted into bank shares in institutions that were actively failing. The test case worked. No riots, no systemic panic. The media called it a necessary measure to prevent collapse, and the legal precedent was set. The United States adopted the same framework 2 years earlier. Title II didn't make headlines because it was buried in a 948-page regulatory bill. But the language is clear. Your deposits are not protected in a systemic crisis. They're part of the resolution strategy. Plus, the FDIC's Deposit Insurance Fund holds approximately $128 billion as of late 2025. Total insured deposits in the United States exceed $9.2 trillion. That's 1.4% coverage. The insurance isn't designed to survive a wave. It's designed to survive individual bank failures in a stable economy. When the maturity wall collapses the commercial real estate sector, and the contagion spreads to regional banks, and the systemically important institutions trigger Title II, your FDIC protection becomes a legal fiction. The math doesn't support a rescue. The law doesn't require one. But even your bank deposits are only half the equation. Let's talk about your brokerage account, the stocks you think you own, the retirement portfolio you've been building for 20 years. You don't own those either. Article 8 of the Uniform Commercial Code reclassified securities ownership in 1994. Before Article 8, if you bought a share of stock, you owned that share. It was registered in your name. It was your property. After Article 8, your brokerage account holds what's legally defined as a security entitlement, not ownership, an entitlement, which means you have a contractual claim to the economic value of the shares, but the shares themselves are owned by the Depository Trust and Clearing Corporation. The DTCC is a private entity that holds $54.2 trillion in securities. Your name isn't on those shares. The DTCC's name is. Your brokerage firm has a claim. You have a claim against your brokerage firm. It's a chain of entitlements. And at every link, there's counterparty risk. You see, if your brokerage firm fails, your security entitlement becomes an unsecured claim in bankruptcy court. The Securities Investor Protection Corporation insures up to $500,000 per account, but SIPC holds just $4.7 billion in total reserves. If a major brokerage collapses, the insurance covers less than 1% of retail accounts, which means the system isn't designed to protect you. It's designed to maintain liquidity for institutional players while you hold the legal risk. This is stage 5, the extraction phase. The Berlin Ghost predicted it. The law enables it. And the 2026 maturity wall just triggered the cascade. In 1922, the Weimar government didn't announce the currency reset. They let inflation erode purchasing power until the reset was mathematically inevitable. Then they issued the Rentenmark, backed by land and industrial assets, and exchanged it at a rate of 1 trillion old marks to 1 new mark. The citizens who held paper lost everything. The citizens who held hard assets survived. The mechanism was legal. The outcome was predictable. And the pattern is repeating. Your deposits are unsecured debt. Your stocks are entitlements. And the laws that govern both were written with stage 7 in mind. The final reset, where the old system is liquidated and a new structure takes its place. The difference between 1922 and 2026 is speed. The Weimar collapse took 11 months from the M2 trigger to hyperinflation. The digital economy moves faster. The algorithms that manage liquidity can reprice your purchasing power in hours, not months. The Berlin Ghost doesn't just rhyme with history. It's running the same code on a faster processor. And the most dangerous part? The mechanism that converts your savings into the system's collateral isn't hidden in some classified vault. It's printed in public law. Title II. Article 8, the fine print you signed when you opened your account. The trap was set decades ago. You've been living inside it, and the 2026 maturity wall just closed the door. But even this legal framework is just the surface. Because the real script, the one that connects the Berlin ghost to the 2026 timeline, runs deeper than Dodd-Frank or the UCC. It's a 70-year imperial cycle that's destroyed 3 superpowers before us, and we're about to hit the exact same terminal stage they did. There's a pattern in history that has destroyed 3 global superpowers. Not a theory, a cycle, 7 stages, mathematical, repeatable. And the United States just entered stage 5. Stage 1 is layering debt. The empire borrows to fund expansion, wars, infrastructure, social programs. The debt is manageable because the empire controls the reserve currency. The interest payments are small, the growth is real, and the math works for a while. Spain hit stage 1 in the 1540s. They had the gold from the New World, the largest navy, the most powerful army, and they borrowed against future silver shipments to fund wars across Europe. Britain hit stage 1 in the 1860s. They had the largest empire in human history, control of global trade routes, and they borrowed to fund the Industrial Revolution. The United States hit stage 1 in 1945. We had the atomic bomb, 50% of global GDP, and we borrowed to rebuild Europe and Asia under the Marshall Plan. The math worked because the empire had real assets backing the debt. Stage 2 is printing. The debt becomes too large to service with tax revenue alone. The empire starts printing currency to cover the gap. The printing is sold as stimulus, economic growth, job creation. The officials promise it's temporary. Spain started printing in 1557. They debased the silver coinage to pay soldiers. The purity dropped from 93% to 34% in 2 decades. Britain started printing in 1914. They suspended the gold standard to fund World War I. The pound was no longer backed by metal. It was backed by faith in the empire. The United States started printing in 1971. Nixon closed the gold window. The dollar was no longer redeemable for gold. It became a fiat currency backed by the full faith and credit of the government, which means the currency was backed by nothing except the empire's ability to enforce its use. Stage 3 is asset bubbles. The printed currency floods into assets, real estate, stocks, commodities. The empire mistakes asset inflation for wealth creation. The GDP numbers look strong, the stock market hits record highs, and the officials declare victory. Spain experienced this in the 1570s. The influx of New World silver caused prices to rise across Europe. Land values tripled. The aristocracy grew rich, but the inflation eroded wages, and the common population couldn't afford basic goods. Britain experienced this in the 1920s, the roaring 20s. Stock prices doubled, real estate boomed. London became the financial capital of the world. But the bubble was built on debt, and the printing required to service that debt. The United States experienced this from 2000 to 2008, the housing bubble. Then the everything bubble from 2020 to 2024. Stock prices hit all-time highs while median wages stagnated. Your home equity doubled, but your purchasing power collapsed. The math reveals the con. Asset inflation isn't wealth. It's monetary debasement wearing a disguise. Stage 4 is the wealth gap. The asset bubbles concentrate wealth at the top. The citizens who own assets get richer. The citizens who sell labor get poorer. The gap becomes mathematically unsustainable. Resentment builds, and the social contract starts to fracture. Spain hit stage 4 in the 1580s. The aristocracy controlled the land. The inflation destroyed the merchant class, and riots broke out in Seville, Valencia, and Madrid. Britain hit stage 4 in the 1920s. The upper class owned the factories and the land. The working class faced unemployment and wage cuts. The general strike of 1926 paralyzed the country for 9 days. The United States hit stage 4 in 2020. The wealth gap reached levels not seen since 1929. The top 1% owned 32% of all wealth. The bottom 50% owned 2%. And the political discourse devolved into tribal warfare. You see, stage 4 isn't about economics anymore. It's about legitimacy. When the math no longer supports the promise of upward mobility, the population stops believing in the system. Stage 5 is social fracturing and internal conflict. The empire turns inward. Political violence, institutional distrust, regional fragmentation. The central government loses control of the narrative, and the extraction phase begins where the state prioritizes survival over the welfare of its citizens. Spain entered stage 5 in 1590. The Spanish Armada was destroyed. The silver flow from the Americas slowed, and King Philip II declared bankruptcy in 1596, the 4th sovereign default in 50 years. The empire began selling titles, land, and monopolies to raise cash. Britain entered stage 5 in 1925. They returned to the gold standard at the pre-war exchange rate, a catastrophic decision that overvalued the pound and crushed exports. Unemployment spiked. The empire began liquidating colonial assets. And by 1931, they abandoned gold again. The United States entered stage 5 in 2024. Political polarization reached historic levels. Trust in institutions collapsed. And the federal government began prioritizing debt service over discretionary spending. The Treasury now spends more on interest payments than on defense, more than on Medicare, more than on anything except Social Security. Which means the government is no longer governing. It's managing a debt spiral. Stage 6 is hyperdebasement. The empire prints at exponential rates to delay the inevitable. The currency loses 50% of its value in months, then 90%. Then it becomes worthless. The population abandons the currency for hard assets. Barter systems emerge, and the legal framework collapses. Spain hit stage 6 in 1599. The silver coinage was debased to 18% purity. Bread riots erupted. And the empire fragmented into regional economies using foreign currencies. Britain never hit full stage 6 because they controlled global trade routes and could export inflation to the colonies. But the pound lost 76% of its purchasing power from 1914 to 1933. The United States is staring at stage 6 in 2026. The M2 expansion is accelerating. The maturity wall is forcing liquidity injections. And the Berlin Ghost shows the mathematical threshold where the debasement becomes irreversible. Stage 7 is the reset. The old currency is liquidated. A new system is introduced. The population is forced to exchange the old for the new at confiscatory rates. And the empire restructures under a different economic model. Spain reset with the Nueva Planta decrees in 1716. The regional economies were forcibly centralized. The currency was reissued, and the empire became a shadow of its former self. Britain reset with the Bretton Woods Agreement in 1944. The pound was pegged to the dollar. The empire was dissolved, and global reserve status transferred to the United States. The United States is approaching stage 7. The reset will likely involve a digital currency, a revaluation of the dollar, and a restructuring of the debt through inflation or default. The timeline points to 2026, the maturity wall, the Berlin Ghost trigger, and the mathematical impossibility of servicing 120% debt to GDP without a currency event. The cycle doesn't care about exceptionalism. It doesn't care about military power or technological advantage. It follows the math. And the math says stage 5 leads to stage 6 within 18 months. The Spanish took 6 years, the British took 6 years, and the Soviets took 900 days. The United States operates in a digital economy where capital moves at the speed of light, which means the transition from stage 5 to stage 6 could happen in weeks, not years. But even this 7-stage pattern is a distraction from the exit clause the elite are using right now. The legal mechanism that allows them to convert your frozen deposits into their liquid assets while you're still trying to figure out what just happened. Most people will ignore this data and pay the price. They'll watch the Berlin Ghost pattern complete its cycle. They'll see the maturity wall collapse. They'll read the headlines about temporary market volatility while their purchasing power evaporates. But if you're the type of person who refuses to be a victim of the script, join the forensic circle. Subscribe. Because the 2026 reset window is closing faster than the official narrative admits. And there's one more mechanism we haven't covered yet. Executive Order 6102, the 1933 gold confiscation protocol. Most people think it's ancient history, but the legal framework is still active. And I'm writing a full autopsy on how it could apply to digital assets in 2026, when the stage 6 debasement begins. Make sure you're subscribed so you don't miss that reveal when it drops. You now see the Berlin Ghost, the 7 stages, the legal clauses, the mathematical certainty that stage 5 leads to stage 6. You understand that your deposits are unsecured debt, your stocks are entitlements, and the reset isn't coming. It's already in motion. The Spanish didn't see it until the silver stopped flowing. The British didn't see it until the pound collapsed. The Soviets didn't see it until the grocery shelves went empty. You're seeing it in real time, and that gives you something they never had, a window to act before the extraction completes. The system isn't breaking. It's working exactly as it was designed, and you are the collateral.